Hi, everyone. Thank you for joining today's webinar. My name is Dave Mantell. I'm a certified financial planner and partner with Stabler Wealth Management. This time of year, we're getting a lot of questions about end of year retirement planning with the big change in a lump sum benefit calculation starting next year. A lot of questions about whether should I retire now, even if it's earlier than I initially expected. And so today's webinar will make sure to hit on all those topics. The presentation today will be on how interest rates affect your lump sum benefit, as well as providing some projections there, and then whether you should retire based on that. So today's presentation for the agenda, we'll break it up into three main parts. We'll kick off talking about how rising interest rates are impacting your lump sum benefit amount. The second section will be on how to determine whether you should retire or not at this time. And then the third section will be that retirement decision timeline. If you do retire, what are some key dates we need to be thinking about and what next actions to be taking? Before I jump in, a little bit about us. Our firm specializes in working with Boeing employees and retirees. In addition to managing our clients' investments, we really focus on full service financial planning, including getting the most out of your wealth, saving on taxes, maximizing your investment return, taking retirement income, and just a full cohesive plan in that regard. A lot of our clients that we work with are either employees approaching retirement, so we're preparing for that transition period into retirement, or transitioning through retirement at this time, or retirees as well. We have a team of certified financial planners. All of our advisors are CFP, certified financial planners on the team. And you can find out more about us and see this content on our website, www.planyourboeingretirement.com. As certified financial planners, our team are fiduciaries. Any advisor that you work with, financial advisor, in addition to being a fiduciary, which means they're required to act in your best interest, we really encourage you to work with a CFP, a certified financial planner. That's an important designation in our view with our industry that provides another level of expertise and knowledge. And so we really do suggest anyone you work with be a CFP. So to launch into the presentation, we'll start off with how rising interest rates are impacting your lump sum benefit amount. So remember, based on your years of service at Boeing, you likely have a pension, annuity. And what that is based on your past service time and average salary, et cetera. You have a certain annuity benefit that once you commence that, you would receive a monthly amount in the form of a pension for the rest of your life. So that's your that's your annuity benefit. A few years back, Boeing started introducing a lump sum benefit option where rather than taking the annuity where you get that fixed payment the rest of your life, you instead can receive one lump sum chunk upfront. The positives of that are you're able to control the money more. You have a means to keep up with inflation. For your own estate planning, it might make sense to get that lump sum to pass on to your family and heirs if something were to happen to you. On the flip side, you are managing that risk, managing that investment money, making sure it works for you the right way throughout your retirement, rather than Boeing managing that risk and sending you a check every month. In this environment, especially with the large inflation that we're seeing, in many cases, it could be compelling to go that lump sum route. Because remember, the pension annuity, the monthly annuity option does not have a cost of living adjustment. So you're receiving the same amount in year one of retirement as you are in year 20 or 30, and you're relying on Boeing to continue to make those payments to you throughout that period. So there's been a lot of attention on the lump sum pension benefit, and a lot of it's based on the calculation. So the way that Boeing does it is they say, okay, based on your annuity benefit, if you're going to take the monthly pension annuity, here's how much you're going to receive each month as a part of that benefit. Based on mortality tables, we expect you to live X number of years. And as a result, Boeing expects you to pay this amount out to you through your pension over your lifetime. With the lump sum, Boeing instead is using a calculation where they're looking at, okay, we're going to give you a lump sum of money today instead of monthly payments over your lifetime. And we want this to match what the annuity benefit would be. And so Boeing makes the assumption that you're going to invest that money in, investment grade quality bond funds, so more conservative type investments. And based on what those bond funds are paying, they will need to give you a certain amount of a lump sum to match the annuity. And so they use segment rates, which are published by the IRS as basically that barometer for what those bonds will be paying you. And so when interest rates are lower, they're assuming you're going to make less on your bond payments. And therefore, they need to give you more money in the form of lump sum to match the annuity. When interest rates are higher, they're assuming you're going to make more income on your bond investments. And therefore, they give you less money in the form of a lump sum to match the annuity. And so the big attention to this right now is the lump sum calculation always uses the prior November segment rates to determine what the lump sum benefit would be. And so it's last November 2021 segment rates that drive what the lump sum is for any 2022 retirements. It is this November 2022 segment rates that would drive next year's retirements. And we've seen a big change in interest rates this year, driving a big difference in the calculation outcome, which we'll go over momentarily. And we do not know what the segment rates are going to be until later in the year. Those November segment rates may not be published until January in certain instances. And so, for example, the most recent segment rates available at this time are August, even though we're filming this, webinar that we're putting on with you in October, right? And therefore, it's going to be at a lag, but based on what other interest rate indicators are, we have a pretty good idea where the rates will be as we approach the end of the year. So looking at the current lump sum landscape, interest rates like I hit on in 2021 as well as 2020 were historically low. As a result of COVID, the Federal Reserve, the government lowered interest rates to very low levels to accommodate the economy. Therefore, any retirements in 2022 will use the calculation from those really low 2021 interest rates, resulting in a much larger lump sum payout. In this case, now we've seen interest rates go up dramatically through 2022 as the Fed is now frantically raising interest rates to combat high inflation that we've seen. And so therefore, where we sit today, segment rates have more than doubled from where they were at the start of the year already. As a result, as we project lump sum payments for 2023 and beyond potentially, we're looking at much higher interest rates, segment rates that'll be used for that calculation for next year's retirements, and therefore a likely much lower lump sum benefit for someone retiring in 2023 versus 2022. It's projected that for many, the lump sum may go down over $200,000 from December 1st of this year commencements to January 1st of next year. In some cases, quite a bit more than that we've seen, 300,000. And so it's really important to look at your numbers, run the math, look at your scenario, because that's a really sizable adjustment that we're seeing as a result of these interest rate changes. This chart shows a good example, going back, many years in terms of where interest rates, segment rates are now versus where they have been. You could see in this chart, as recent as last year, segment rates were close to zero, very, very low across the board. This year, in the first, 3 quarters of the year, we've seen segment rates jump up a bunch, right, to kind of levels that we haven't seen for a decade or so. And, we'll see where it goes going forward. There's always a possibility interest rates, segment rates go up further, impacting future retirement lump sum benefits. For example, for somebody that was to retire in 1990, using the segment rates at that time, you would basically get half of the lump sum benefit as you would using 2021 segment rates, right? And so we're going to see a pretty dramatic, reduction in lump sums going into 2023. And then we'll see going forward where that goes based on where interest rates are. Seattle Times provided a really interesting article recently that we actually sent out to all of our contacts. But basically, it just goes over what we just talked about, how rising interest rates will really cut into the Boeing pension lump sum payouts. And they came up with a number that for a typical employee age 60, a 1% increase in the rates will slice $78,000 off a lump sum. So that's a really dramatic amount. And so again, we've seen the level of segment rates go from the neighborhood of 1 to 2%, up to that 4+% that we're looking at this time. And so again, that kind of aligns with the big changes in the lump sum benefits that we're seeing. Also noted in this article, everybody's thinking about this at this point, right? As everybody should be. And so there is worry that there's going to be quite an exodus of retirees, specifically engineers from Boeing at the end of the year. And that kind of brings up, what does that mean for Boeing going forward from a culture, from a workload perspective, given this massive, potential, run of retirements that may be occurring here. If you look at 2018 and you see how interest rates, went up dramatically from 2017 to 2018, you had a similar response. This shows a number of retirees. This is from SPIA for BCERP commencements by month. And you could see how large the December commencements were versus the rest of the calendar year and how many of them were lump sum. This increase in interest rates from last November to this November, we expect to be quite a bit more dramatic than 2017 to 2018. And so you may see an even more extreme response as a result of these big calculation changes regarding the segment rate input. So with that being said, so that we're all aware there's a real meaningful difference in the lump sum calculation inputs that will drive down lump sum values, starting in January. And so that begs the question, what do I do about it? How to determine whether you should retire? And so, like we went over, if you are going to take the lump sum, delaying your retirement date can have a big impact. This shows an example of a 60-year-old BCERP lump sum pension, so a SPIA employee. And this assumes someone whose lump sum was about $1 million a year based on the November of 2021 segment rates and what the change would be. So from November of last year through August of 2022, which at this time is the most available segment rates that we have, you could see that the average segment rate across the three groupings went from a little over 2% to over 4%. So essentially a double already. Since then, since August, we've continued to see interest rates go up dramatically regarding 2-year government bonds, 10-year government bond rates. And so our expectation is it looks like we're going to see further increase as September, October, November segment rates post. We're not in November yet, of course, so things can change. We could see rates pull back a bit. But in this scenario, that 60-year-old, SPIA Boeing employee with $1 million lump sum, they would have, based on the August segment rates, see about $182,000 reduction in their lump sum from December of this year to January of next year. If interest rates tick up further, that can be quite a bit more of a drop, than even we have budgeted here. So something to be aware of. If you're taking the annuity benefit, right, which in some cases makes a lot of sense, depending on your specific situation, it doesn't make a difference, right? This is just a lump sum calculation mechanics. Your annuity is not going to be impacted, your annuity pension benefit, whether you retire this year or next year from these segment rate changes. This is only if you're taking the lump sum. The lump sum has become very compelling based on these low interest rates, in many instances. But again, there's certain scenarios where the annuity will make more sense for you, right? And so it's if you're taking the lump sum where you're going to see the sizable reduction going into next year. So the first question to ask yourself is, how far are you from your original planned retirement date? And by doing so, we could look at how much we project your lump sum to decrease between December and January of next year, and then compare that to how much you'd be making in salary and benefits from Boeing if you can continue to work for your planned retirement date. And so, for example, someone that was planning and retiring in 2023, if you're going to gain 200,000 on your lump sum by retiring this December versus next year, or another way of saying it, if your lump sum is going to go down 200,000 by waiting next year to retire, you got to take a hard look at moving up your retirement date. Because if someone making $150,000 salary, if you're going to lose 200,000 on your lump sum by working an extra year, you're basically paying Boeing to work that extra year. Which Boeing, I'm sure, has been good to you, but you do not want to be paying someone to work, right? You need to be getting compensated for your time and services. If you are planning on retiring in 3 years, it may not make sense. It may not be compelling enough, even with a reduction in lump sum benefit, to move up your retirement date by 3 years, right? Or 4 years. So it all depends on when you are planning on retiring and how that fits into your picture. Second question to ask is, are you able to retire? So for anybody within a handful of years of retirement at Boeing, really recommend doing a retirement trial run. And so your planned retirement date is one data point when you are planning on retiring, though when you can retire is another data point. And so we see it pretty commonly where folks say, um, you know, uh, I plan on retiring at age, 60, or I plan on retiring when my, 401k gets up to $1.5 million or whatever the number may be. But, that's different than, are you in a position to retire, right? And so due to Boeing's early retirement medical plan, which most companies don't get, when you retire from other companies, and the pension lump sum benefit, many employees at Boeing are in a good position to retire in their, mid to late 50s, right? 55 is a bit of a magic number when you could look at retiring. But, just because you're thinking 60 in your head, you might be in a great position to retire at 58, right? Or 59. And so again, everybody's situation is different. So you got to do a trial run and look at and run the math and run the numbers just to see what position you're in. Because again, you got to have your eyes open on this, in our opinion, given the massive changes in the lump sum benefits, where your lump sum can go down 20 to 25% in a month, right? So you want to make sure if you're deciding to work longer, if you're in that arm's length of a retirement, it makes sense to do so. Question 3, would you consider returning to Boeing as either a contract or a full-time employee if you did retire? And so, you do not have to retire from working to capture the higher lump sum retirement benefit. You just need to commence your retirement from Boeing at this time. And so therefore, you can retire, take your lump sum benefit, wait the required 60 days, and then potentially go back and work at Boeing again at either a contract position or a full-time position. I know there's been a lot of attention at Boeing, one, with the mass wave of retirements expected, plus two, a focus on more, hiring engineers, allocating more resources to engineers. And therefore, there could be a scenario where you may, be able to be hired back in a same or similar role while still capturing that higher lump sum benefit amount. This provides a lot of risk, right? If you're a contract worker, it's much easier to get laid off, right? Versus a full-time employee. You have to take that 60-day sabbatical, let's call it, right? Time between when you retire and if you were going to be rehired at Boeing. And so a lot can change then. Your manager may say, hey, we got a spot for you, but things can change quickly. So this would be a risk if you're relying on this. But if it's really borderline or the math works, but you may just say, hey, I'm not exactly ready to retire. I got a little bit more in the tank. This could be a really good option to look at where you possibly retire, commence your benefit, get paid out on your large lump sum amount, and then take 60 days off and then possibly, get rehired at Boeing or another employer for reasoning, right? It doesn't have to be Boeing if there's other, employers that you'd also be interested at working with. And so again, this role has some risk, right? You're going to be without a job for a while. But based on the numbers, if this could save you $250,000 on your lump sum benefit and you're within that arm's length of retirement, it could be worth a risk, so something to review and look at as well. Um, you know, we're getting a lot of feedback about the angst out there, given the bear market, the down stock market that we've been in. It's been a very turbulent year. And it does look likely that we're going to have a recession at some point, right on top of that. And so that creates a lot of angst, especially saying, hey, I'm retiring in this really difficult scenario. Can I retire, right? Am I going to be okay? And while it feels a little counterintuitive, with the lump sum, a down stock market can actually be a very, very good time to retire. Your lump sum benefit amount is not impacted directly by the stock market, right? It's based on segment rates and mortality rates. And therefore, your lump sum, if you're going to retire, you're getting a big chunk of cash that has not been exposed to the market. And the stock market, as a time of this webinar, right, is down about 25% from its highs. Certain sectors like technology down quite a bit more than that. And so, of course, during these turbulent times, things can go down further temporarily, but we're seeing pretty attractive pricing in a lot of areas. So if you come across, $1 million or $1 million plus lump sum benefit in the form of cash in a down market, this is a really good time to be able to dollar cost average in, layer in and potentially add some to those stock and growth investments at a low price point. Again, you need to do this in adherence with your financial retirement plan. Everyone's situation is different. Likely not all of your lump sum is going to go in the stock market, of course, but this could be a really attractive time to do that. And then on top of that, we're seeing really attractive retirement income yields on more, conservative, moderate investments as well. And so as you kind of layer those funds in, you do have an opportunity to earn really good income on your lump sum balance in the meantime. Okay, so again, I know it can be scary and concerning retiring, during a difficult market like this. But again, these bear markets happen, and it's staying the course of your financial plan and being prepared for it is how you weather these. And having a big chunk of cash that you can deploy at a low market price and buy low can be a very attractive timing proposition as well. All right, so once you project what your lump sum benefit will be, you do the math, run the trial to see if it makes sense to retire or not. The next element is that retirement decision timeline. And so the first thing is, how do I retire? So the last opportunity to receive the higher lump sum amount is if you terminate your employment at the end of November and you commence your pension December 1st. These are two different things to do in two different timelines. You can request a commencement packet for your pension now. You could do it up to 90 days prior to your commencement date. And if you are considering retirement this year, you should do that right away. Request a commencement packet, get a hard copy of that, be able to review the numbers and kind of pour over them. And so something we really encourage doing is requesting the commencement packet now. If you do plan to retire at the end of the year to get the higher lump sum benefits, we do recommend, getting that commencement packet submitted, early November, let's call it, just so administratively, you're doing it with plenty of time, 30 days or so before your retirement date. So that's something we definitely recommend. If you are to terminate your employment, so that's a different date and timeline, right? And so for the commencement pension, request your packet now, look to get that in by early November, at the latest, if you do decide to retire. For informing Boeing that you're terminating your employment, you would be retiring November 30th, right? So at the end of November, not December 1st. And you have to initiate your termination within 14 days of your termination date, right? So you can't do that now if you're retiring November 30th. That would have to be done within a couple of weeks of that date. And so that's when things become official, right? When you terminate. I would say if you're going to submit your commencement packet, at the start of November, it'd be good to have made a decision by that time. So you're not trying to reverse that commencement. But again, that 2 weeks before your termination date, when you put in your termination, that's really, when it becomes a official. So retirement health insurance. If you qualify for Boeing's early retirement medical, in most cases, meaning if you're last hired from Boeing before 2007, make sure your spouse is on your insurance prior to retiring. That way they will also enjoy the spousal early retirement benefits too. So something really important to double check. In some cases, your spouse may be working as well and, be on their employer insurance. When you retire, you want to make sure that they are on your insurance. So so they will also receive those early retirement medical benefits to take them to Medicare age. Medicare starts at 65, right? That's when you move from the Boeing early retirement medical to Medicare. If you turn 65 before your spouse, when you go on Medicare, you need to make sure to elect the Boeing supplemental option. This way, you still have Boeing health insurance. For your spouse to be on Boeing insurance, you have to be on some form of Boeing health insurance. And so once you reach Medicare age, that's something you need to make sure to do. And this supplemental tends to be a bit pricey, right? It's good in some cases, other cases it may not make sense for you. But once your spouse is also on Medicare, you could cancel that supplemental if you determine it's not a fit. But especially when you retire, make sure your spouse is on your health insurance benefits. And then the other item is establish a plan for retirement income in your investment accounts, right? Do that retirement trial run. Model out how that's going to work. Once I retire, how much retirement income can I take? Where do I take it from? Which account? How do I do that tax efficiently? And so when you retire from Boeing, in your retirement packet, you can elect for a tax deferred rollover of your 401k. Likewise, 401k to your IRA. Likewise, with your lump sum benefit, you can elect to either have that go into your 401k or to an outside retirement account tax deferred. You need to make sure you choose a tax deferred option on these so you don't get an unexpected tax bill, right? You want to make sure you're deferring the taxes. So that lump sum will go into your IRA account where you could continue to defer it accordingly. And you only pay tax when you take out the money from the lump sum or from your 401k or IRA. That's only when it's taxed. It's tax deferred. If you are under the age of 59 and a half, really recommend we talk about it, but you need to make sure you're able to avoid early retirement penalties by taking draws from certain types of accounts. As long as you're 55 and retiring, there's ways to circumvent this so you don't have any penalties when you draw from your retirement accounts. So again, something to really map out and have a game plan on. I have a note here about NUA, net unrealized appreciation transfer of your Boeing stock. If you're interested, happy to talk about that. With the performance of Boeing stock, that hasn't been as much of a factor as of recent date, but if that's something you're interested in, a decision you want to make ahead of retiring as well. So as noted earlier in this presentation, complete that trial run of your retirement plan today. If you're going to retire this year, make sure you check all those boxes to make sure you're in a position to and doing everything the right way and you're prepared for it. If you're thinking about retirement but not sure, do the exercise, right? You may be surprised about the position that you're in or be surprised how much your lump sum benefit may go down next year, right? In cases, it could be 200,000-300,000. That's a massive amount. So we really recommend working with a certified financial planner on your retirement journey, do the trial run, and that way you could make a decision with confidence no matter which direction that you go. Just like we've offered in past webinars, take us up on our free second opinion. We'll do kind of a retirement trial run with you, look at your retirement plan, look at your investments and give you our feedback. This is a 1-hour complimentary review. to look at your specific picture. So really suggest anyone, within 3, 4, 5 years of retirement, let's do the exercise and take us up on this. Yeah, to set up this appointment, you can reach out to Sean from our team, Sean O'Connor. Our number is 425-646-6327. You could also email Sean at sean@stablerwm.com. But again, we really encourage anyone on the fence or even within that arm's length of a retirement to really do the diligence, do the work to make sure you're making the right decision. Whether to take your lump sum benefit or the annuity, monthly annuity pension, and when to retire are likely going to be the two biggest financial decisions you make in your life, right? So it's just too important to not turn over every stone when you're looking at this. We're going to be holding more of these Boeing seminars and webinars going forward, covering other key topics. If there's any topics you'd be interested in us looking at down the road, please let us know. We appreciate any feedback you have. And then please extend these invitations to your colleagues. Feel free to pass on their information if you want them added to our communications list. Likewise, feel free to forward anything on, that we send you. But we'll try to keep providing good content to help you make good financial decisions. And like I noted, encourage anyone listening to reach out to us as well, so we can do a one-on-one look at your retirement picture. So thanks again for joining us today. I really appreciate it. And contact us with any questions that you may have. Have a great rest of your day. Thank you.